And Shane, I know you caught a little bit of that conversation that we just had with the Bank of Korea governor as well. He was also suggesting a possible downshift, but very difficult to judge with so many macro variables to think about. But can we say with certainty that we're closer to the end of the tightening cycle now than the beginning?
I think we certainly can. You go back 6 months ago, global growth was still strong, economic indicators were still on the high side, and there wasn't much sign that inflationary pressures were decelerating, whereas now you can see more evidence globally that economic conditions are slowing quite rapidly. We've got slower inflation indicators, particularly coming out of the US, particularly on the supply side, but that will flow through to the demand side as well. And so therefore it makes sense for central banks to start slowing the pace of hikes, particularly given that many of them have already hiked by so much. And therefore I think it makes sense for the Bank of Korea, therefore, to slow down the pace, I guess following what the Reserve Bank did a month or so ago. And of course also indicate in terms of their terminal rate that we may be getting close to the top. So I think it all makes sense to me. Now it's about managing the downswing in growth and making sure that they don't over-tighten and end up with excessively low inflation. So I think what we heard from the Bank of Korea, along with several other banks recently, has been it does make sense.
Yeah, the governor suggesting a terminal rate of 3.5%, although that may obviously be subject to change. But you mentioned inflation. The governor said that there are signs that it's coming under control. But I know that you think that inflation could slow a lot more sharply than a number of market watchers are anticipating. What are the risks associated with that, and what would drive sharply slowing inflation?
Well, I think if we go back a year ago, people were still talking about the rise in inflation being temporary. The Fed was talking about that we can be patient in moving to eventually raise interest rates. And then, of course, we got surprised on the upside. So that, of course, encourages the whole market and most commentators to think, well, the surprises are all going to be on the upside. And the risk is that we get caught out again and inflation comes down a lot quicker. We have seen supply side indicators improve dramatically. Cost of shipping has fallen sharply. Some of the rental pressures in the US are starting to abate, with many cities now seeing declines in rents. Used car prices, goods price inflation has already rolled over in the US. And when you look at business surveys, including the PMIs that came out a night or so ago or yesterday, they're all showing a continued downtrend in order backlogs. Delivery times have improved, input and output prices are coming down, albeit they're still high. And as economic conditions slow further as we go through next year, I think that will lead to the final piece in the puzzle. Services inflation will start to slow down as well as labour markets start to ease up. The very tight labour markets start to give way to somewhat softer labour markets, reducing worker bargaining power. So I think all of those things risk surprising central bankers on the downside regarding inflation. On the one hand, that would be good for investment markets because it will mean ultimately lower interest rates.
That's right, Shane.
And lower bond yields, which will help valuations.
That's interesting because I think a lot of people in the market still think, yes, we may have reached a peak in inflation, but it's going to take a long time for prices to go much lower from where we came from before the pandemic. I have to ask then, how does the China reopening story change your thesis in any way? If we see China exit out of COVID zero, could that be a big spike in inflation? Or do you think that this could be pretty, manageable?
I lean to the view that it's probably going to be more manageable. What happened in many of the other countries was that they'd pumped in a lot of cash into households, so households were cashed up, lots of spending power through government support. Like in Australia, we had JobKeeper and furlough schemes and all these sorts of things meant that households were cashed up. Households in China aren't quite as cashed up, and therefore there's perhaps not as much pent-up demand as there has been in other Western countries. So therefore, I think the bigger impact from China reopening will be an improvement in supply chains, a further improvement in supply chains, easing in supply pressures, and I think that would ultimately be a good thing. Where it may impact is possibly commodity prices, may be given a lift higher, which might be positive for the Aussie dollar and the Australian share market. That's probably the key one to watch there, but I don't think we're going to see quite the same degree of pressure, reopening pressure on inflation that we saw in Western countries.
So if inflation slows faster than what markets are expecting, Shane, what does the path to rate cuts look like for central banks in our region then? I mean, how soon could we actually see that sort of pivot?
Well, I think it's still a fair way off. Obviously, central banks right here, right now, are still talking about rate hikes, including the Bank of Korea, currently 3.25, talking about a terminal rate 3.5, maybe 3.75. I think one member in their committee was saying we're already there, but the majority view was still a bit further to go. I think by the time we get to the early part of next year, central banks will have concluded this is it, particularly those in Asia and probably also in the US. Maybe Europe might go for a little bit longer because it's lagging a little bit more. Rate cuts probably won't come till later next year at the earliest, or maybe 2024, but that's a long way off. So I suspect the more likely scenario is we get to a point where rates are at that so-called terminal rate, maybe 50 basis points above where we are now, depending on which central bank you're talking about, and then they stay at that level for some time to come. It is just worth noting from history that in history, in the last 4 or 5 occasions, whenever the 10-year bond yield in the US slipped below the Fed funds rate or the Fed funds rate rose above the 10-year bond yield, the Fed went on a pause. So that's happening right now. So it is actually consistent with even the Fed pausing soon. I don't think they're going to pause in December. I think they'll do 50, but it's quite conceivable that their next meeting in, I think, late January or early February, they will actually have a pause.